All right, here we go. Does a bank ever run out of money? Somebody answer that. Does a bank ever run out of money? Let me ask you this. Can you drive from California to New York City on one tank of gas? Answer is no. You got to refill up, right? You got to get more gas. Same thing with a bank. Here's the basic concept. When a bank lends out home loan money, they're lending out capital they have, right? Presently have capital in their inventory they lend out. That's called intermediation. I got a lot of money. I'm full of gas, full of money. I'm going to lend it out. Now my capital decreases. I'm in a disintermediation state. My gas tank's empty. I got to find a way to get more gas. I got to find a way to get more money. So the bank has to come up with a way to get more money. One of the ways they do it is they go to the secondary market. Okay. The primary market is where they create loans. Remember, you want to know what intermediation is? That's the flow of funds that are available. Disintermediation means the capital is tied up and they don't have money to lend out. So they go to the secondary market. What do, John? They take the loans on hand, right? Hundreds of millions of dollars worth of home loans that they have. They'll sell them to Fannie Mae, Ginnie Mae, or Freddie Mac. They buy the loans. They're called warehousing agencies, where they take the loans and they'll service them out for the term of life. Now the banks have money back to lend out more money, all right, to home loans. Then they'll get to a disintermediation state, and they'll sell the loans again to the secondary market. So the secondary market is only purpose is to buy loans from the primary market. You don't go to Fannie Mae and borrow money. You go to Chase Bank and borrow money. They'll take your loan and sell it to Fannie Mae so they can get more money to lend out to your friend. Okay? That's called the primary market and the secondary market. Now, in the secondary market, Fannie Mae buys and sells conventional, FHA, and VA, all three loans. They buy them all from the primary market. Ginnie Mae is strictly government. Okay. And then Freddie Mac only buys conventional loans. They don't mess with government loans. Okay. So you may get a question that reads, secondary financing refers to what? Okay. Anytime you see the word primary market, secondary financing, you have to go back and vision this. This is what you need to create. This is what needs to be in your mind when you start talking about the primary and secondary market. You need to see this. If you can see this and understand this financial concept, that's 90% of the mortgage industry that we deal with in real estate. Okay. Now, you're not going to need to know this when you get in real life, right? Because we have lenders that take care of all that for your clients. But for your test and for the fact that you can educate and create value for your clients, you want to picture this. The bank full of money, maybe perhaps they sold a lot of loans, an LOT, not a lot, but a lot, meaning a bundle. Maybe it was worth, 100 million worth of loans sold to Fannie Mae. Now they've got 100 million back, and they're going to turn around and make more loans out. The fact that they sold the loans and they got the flow of capital in their presence is called intermediation. Full tank of gas. Now here comes along the guy leaning against his house with the money bag, wants to borrow from the bank. Okay, and you times that 10, 15, 20,000 people, now your bank's going to have a disintermediation standpoint to where there's no more money left. It's tied up in loans. We're only collecting monthly principal and interest or monthly P&I. So now as a bank, We need to sell more loans. Well, we don't have the money. Well, let's take some loans we got, the bundle of loans we got, again, 100, however many, 10, 15 million, whatever it is, we're going to sell it to Fannie Mae and reclaim that money, turn around and lend it out. Say, well, John, what's the purpose of that? Why not just accept the loans in full payment? Because all the money's made up front. Let me show you. I did this calculation. I know it by heart. Numbers may have changed, but let me just give you an example. Estimate 5,000 Chase banks in the United States, branch offices. Let's say out of 5,000 branches, all of them, let's say they average 10 loans, 5,000 times 10 loans a month. 50,000 loans are made a month in this example. Okay, I'm not saying these are real numbers. This is an example. 5,000 branches. They do 10 loans a month. 5,000 branches. That's 50,000 loans are made out per month. Now, let's just do the origination fee at 1% times 0.0. Let's see here. 0.01. Okay, so we got 5,000 banks times 10 loans a month, 50,000 times 0.01. So we got, wait, I got that wrong. Hold on one second. 5,000 banks times 10 loans. So we got 50,000 loans going out. I forgot to put a price to it. So let's say, I'm just going to use the easy number. Let's say each of these loans, 50,000 per month that go out. Let's say each of these loans are 100,000. Okay. And then I'm going to go times 0.01, which is 1% origination fee. So I've got 1, 2, 3. Let's see, 1, 2, 3. 1, 2, 3. 50 million in 1% origination loans. If there's 5,000 banks doing 10 loans a month at $100,000, tens of millions of dollars are made up front just in origination fees. Forget discount points and all that other stuff. And I think it's more than 1%. I was just using basic numbers. My whole point is, do they want to sit on these loans for 30 years and collect the interest? Or would they rather turn around and sell it to the secondary market, take all that money, lend it out again, and make up because they get that money right away. That finance charge is on the CD. Okay. It's on the closing disclosure form. So the buyer's got to pay those finance charges up front. So the whole point of the primary market and the secondary market, primary market is where loans are originated. Secondary market is where they're bought. Now, the secondary market does sell some of their loans to private investors as mortgage-backed securities to reclaim money to turn around and buy from the primary market again. Okay, but here's the picture you want to understand when it comes to financing home loans from the primary market to the secondary market. Okay, and again, the primary market consists of savings associations. That's what SA is. Commercial banks, credit union. That's where loans are originated. Intermediation means they got money to lend out. Disintermediation means they don't. This is where they go to the secondary market, Fannie Mae, Ginnie Mae, and Freddie Mac, okay, to sell their loans, to recoup, to lend money back out, okay? And so when you're looking at the secondary financing or secondary market, remember, secondary financing doesn't mean a second loan or a second mortgage. They're talking about markets. The marketplace, primary market meaning where money is lent, loans are originated. Secondary market is where they're bought, okay, from the primary market. So a secondary financing is going to refer to the sale of an existing loan into a secondary market, okay? So we're looking at answer B, okay? Rest your eyes. You really want to become familiar with this concept here because there's a lot of questions they can ask. And, interesting enough, we talked about the secondary market, But these banks that get to a disintermediation state can actually go to the Federal Reserve district banks. In the United States, there's 12 district banks the Federal Reserve has, and these banks can borrow from these federal district banks at low interest rates, and then turn them around and sell the loans at market value interest rates. That's called discounting. And the difference between what they buy and sell it at is called arbitration. Okay, arbitration. We borrowed from the Federal Reserve, say at 0.75%, we're turning around and lending it out at 6%. That difference is called arbitration, and it's called discounting. And they can borrow, again, bundles of loans from the Federal Reserve. They can sell some loans to the secondary market, and also they can capture from their client base product lines they sell, like CDs, opening savings accounts. So they get money from the public that has accounts there too. So there's a couple of sources of income that these banks can get to be able to lend out for home loans. Okay.
For more practice questions, videos, and insight into the state exam, we encourage you to join our free webinar, How to Pass the Real Estate Exam Without Your Real Estate Book and with only 15 to 20 hours of study time. Get registered now at myrealestatetutor.com/exam.